Hello people, today we are going to learn about short-term liabilities. So let's see. What are short-term liabilities? Short-term liabilities are debts or obligation arising from past transaction or event, and the maturity are usually less than 1 year. If it is uh, greater than 1 year, it is a long-term, and long-term also called as non-concurrent liability. If it is less than 1 year, it is a current liability or short-term liability. Distinction between debt and equity. The acquisition of asset is financed from two sources, debt and equity. What is debt? Debt are the funds from creditors with a definite due date and sometimes bearing interest. What is equity? Equities are funds from owners. So let's see an example to understand more on what is current and non-current liability. So there is a company called Devon Manufacturing, borrows 100,000 from First Bank. The loan will be repaid in 20 years and has annual interest a rate of 8%. Is this a current liability or a non-current liability? So since the obligation will not be paid within 1 year, because it says that the loan will be repaid in 20 years. So it's not one less than 1 year or 1 year, then this becomes a non-current liability, which is a short-term liability. Evaluating liquidity, an important indicator of company's ability to meet its current obligation. So, two commonly used measures for evaluating liquidity is working capital and current ratio. Working capital can be calculated as current asset minus current liabilities, and current ratio can be calculated using this formula, which says current asset divided by current liabilities. Let's see an example to understand the current ratio. Devon Manufacturing has current liability of about 230,000 and current asset of 322,000. What is Devon's current ratio? Current ratio is current asset over current liabilities, as we saw before here. So we can just put the value of current asset, which is 322,000, over 230,000, which is current liability. So the answer we will get is 1.4. Accounts payable. What are accounts payable? Short-term obligations to suppliers for purchases of merchandise and to others for goods and services. Example are merchandise inventory invoices, shipping charges, office supplies and invoices, utility and phone bills. So these are the examples of accounts payable in case of short-term obligations. What are notes payable? When a company borrows money, a notes payable is created. Current portion of notes payable. The portion of notes payable that is due within 1 year or one operating cycle, whichever is longer. Total notes payable is current notes payable and non-current notes payable, which is short-term notes payable and long-term notes payable. So let's see an example to understand. On November 1, 2015, XYZ agrees to pay 10,000 to ABC Bank. XYZ would make the following entry. So on November 1, it will write cash debit of 10,000 and notes payable credit of 10,000. Interest payable. Interest expense is the compensation to the lender for giving up the use of money for a period of time. The liability is called interest payable. To the lender, interest is revenue. To the borrower, interest is an expense. The interest formula includes three variables that must be considered when computing interest. So the formula used is interest is equal to principal multiplied by interest rate multiplied by time. When computing interest for 1 year, time equals 1. When the computation is period is less than 1 year, then time is a fraction. For example, if we needed to compute interest for 3 months, time would be 3 divided by 12. 3 is the month for which we have to compute the interest, and 12 is the total number of months in a year. So the fraction will be 3 divided by 12, which we will use in place of time, and principal and interest would be given. Interest payable example. So let's see another example to understand the interest payable. What entry would XYZ make on December 31st, the fiscal year end? So it started from November 1 until December 31st. There are 2 months. So how we can calculate the time? 2 divided by 12. 12 is the total number of months, and 2 months period we have to calculate the interest expense. So 2 divided by 12, and interest rate is given is 12%, and the principal amount is 10,000. So 10,000 multiplied by 12% multiplied by 2 over 12 will give us $200. So journal entry will look like this: interest expense debit of 200, interest payable credit of 200. Payroll liabilities: gross pay, net pay. Uh, gross pay is FICA taxes, Medicare taxes, federal income taxes, state and local income taxes, voluntary deductions. So gross pay include these many things, and net pay is just the dollar amount which goes in the bank account. Unearned revenue. Cash is sometimes collected from the customer before the revenue is actually earned. As the earning process is completed, here is the unearned revenue is also a liability account, because unearned revenue is the amount of money which you get in advance before performing your service. So only unearned revenue becomes revenue only when you have performed the service for which you got an advance. So what happens is cash is received in advance, then deferred revenue is recorded, and then earned revenue is recorded. So here, when you have performed the service, you have earned this deferred revenue, and it becomes your revenue, earned revenue. So guys, I hope you got some idea on short-term liabilities. In next video, we'll talk about the long-term liabilities. So subscribe to my channel, and thanks for watching.